So I've been doing my own crypto taxes for about 4 years now, and I've learned a lot along the way, but if there's one thing that always sticks with me, it's that bad feeling I get in my gut whenever tax season rolls around. But fortunately, every year it gets a little less intense, and I think that just comes with experience. So to help ease that gut ache for you when tax season rolls around, I'm going to share everything I've learned in this video, from what is and isn't taxable to the exact tool that I use that basically does my crypto taxes for me. By the end of this video, you'll be ready to file your own crypto taxes or hand them off to a tax professional with confidence. So let's start with the elephant in the room. Why even file crypto taxes? Isn't the whole point of crypto to say F you to the government and take back control of what's ours? Maybe, but that doesn't mean that the government isn't going to say F you right back and come after you if you don't file your crypto earnings. In fact, not filing your crypto taxes can lead to severe consequences, at least for US taxpayers, including fines of up to $100,000 as well as jail time. So if you want to avoid that stuff, then you should probably consider filing your crypto taxes. And if you're thinking you can just skip reporting your crypto earnings or losses to the IRS, think again, because the IRS has already been cracking down on crypto taxes. They've been going after major crypto exchanges like Kraken to get account info on anyone who's done at least $20,000 in transactions. So they're definitely paying attention. So if you trade crypto on a platform that's in compliance with US laws, such as the most popular exchanges like Coinbase, Binance, or even Robinhood, then they know exactly what you're doing. They know all of your crypto transactions. However, if you're using a non-compliant platform such as an offshore exchange, then it is possible that the IRS has no idea what you're up to. So what is a taxable event? In simple terms, is any occurrence or transaction that requires you to pay taxes. But taxable events aren't just limited to cryptocurrencies, it also includes other digital assets. The IRS clearly states that taxpayers need to report crypto and other digital asset transactions on their tax reports. But how does the IRS define crypto and other digital assets? According to their website, a digital asset is a digital representation of value that is recorded on a cryptographically secured distributed ledger or any similar technology. So basically anything that lives on a blockchain network is potentially taxable. Some common digital assets include convertible digital currency and cryptocurrency, stable coins, and non-fungible tokens, aka NFTs. But with so much going on in crypto, it's hard to understand what is and isn't a taxable event in crypto. Fortunately for us, the IRS has clearly defined what is and isn't a taxable event. And if there's one thing I want you to take away from this video, it's this. Anytime you give up ownership of a token or crypto, you experience either a gain or a loss, which is a taxable event, which means you should report it on your taxes. For example, if you buy Bitcoin and convert it to ETH, you experience either a gain or a loss. This is based on the difference between the price you sold your Bitcoin for during the conversion and the original cost of your Bitcoin or your cost basis. If you made profit, you owe money on it. If you lost money, then you can claim a deduction. In fact, I've learned there are really only two events that aren't considered a taxable event in crypto. The first one is if you buy a cryptocurrency and you just hold it. So I take $100 and I buy $100 worth of Bitcoin and I just let it sit there. I don't do anything with it. And the second action is transferring your crypto from one wallet to another crypto, assuming you're not also converting that crypto. But if I just transfer Bitcoin from my Coinbase account to my Ledger hardware wallet, that is not a taxable event. But literally everything else is a taxable event. So here's a small list of taxable events. So if you've done any of these, then you should probably report your crypto when filing your taxes. If you have received digital assets as payments for goods or services, received digital assets as rewards or awards, such as an airdrop, if you've acquired new digital assets through mining, staking, or similar activities, if you've received digital assets from a hard fork, if you've ever exchanged digital assets for goods or services, or if you've traded one digital asset for another, if you've sold a digital asset, or if you got rid of any other financial interest in a digital asset, such as if you donate it or abandon it altogether because it became worthless or maybe your crypto was stolen. These are all taxable events, but let me be very clear. You only pay taxes on profits, so if you lose money, you can actually report those as a deduction on your taxes. And these losses can offset any gains you've made in other investments, which reduces your overall tax liability and thus the amount you owe the government. Of course, if you make a crap ton of money in crypto, then you have to give the government their cut. But this is a good problem to have in my opinion. Now, I'm not a tax professional and I'm not going to give you financial advice. I will tell you what I do though, because I have made a decent amount of money in crypto. When I take profit, I take it and I set it aside and I forget about it. That is until tax season rolls around when it comes time to pay my taxes. Then I take whatever I need from that profit to pay my taxes, and then whatever's left over, I can do whatever the heck I want with. Of course, it sucks that I have to give my money to the government, but you know what would suck even more? A $100,000 fine and sharing a jail cell with this guy. I mean, come on. Now, something else I wondered when I first started doing my crypto taxes is what if I just take my profits and then reinvest them into other cryptocurrencies? Then I don't have to pay the taxes on my initial profit, right? Wrong. Even though the IRS treats digital assets as property and general property tax principles apply, every time you sell or exchange crypto, it's considered a taxable event, regardless of whether you reinvest the proceeds or not. So while something like real estate allows you to reinvest your profits into other assets, that doesn't apply to digital assets. Why? Because the government says so. That said, crypto is taxed in various ways. For example, if you invest in crypto, then you're either paying short-term or long-term capital gains. If you sell it after holding it for less than a year, you pay short-term capital gains. If you sell it after holding it for more than a year, then you pay long-term capital gains. And how much you owe ultimately depends on how much you make, not just from crypto, but from your job and any other sources of income. But crypto can also be taxed as ordinary income, such as the money that you make from your job. For example, 90% of my paychecks are paid out to me in crypto, so I tax that as ordinary income. So if you receive crypto for any products or services that you offer, then you might tax that as ordinary income. And this is where crypto taxes get confusing. It's almost like you need to be an expert just to file your own crypto taxes. Like, how do you gather all the transaction data and then categorize each transaction and then report the documents needed to file to the IRS? It's a pain in the ass, especially if you're like me and you have thousands of transactions to report every year, or even hundreds of transactions. It's all just very overwhelming. But I found out it doesn't have to be. If you only trade crypto on a US compliant exchange like Coinbase or Robinhood, then they're going to provide you with all the necessary tax documents come the end of the year. But there are some exceptions to this. This only applies if you're a US customer who pays taxes in the US, and it only applies if you've earned at least $600 in income, whether that's through staking rewards or just the value of your cryptocurrency going up $600. So that means if you aren't a US customer or you've earned less than $600, then you have to go and get those crypto transaction reports yourself from whatever exchange you use. And that's a lot of work. Nobody wants to do that. And aside from that, there's an even greater issue. Most of us don't just use crypto exchanges. We also have hot wallets like MetaMask and hardware wallets like Ledger. So how do we gather all the information from all of these wallets? Well, you could do it all manually, but that would be extremely difficult and time consuming, or you could hire someone to do it for you, but my guess is that would be extremely expensive. Or you can do what I do and use a crypto tax software that gathers all this data for you, categorizes each transaction, and then spits out a tax report that you can either file yourself using something like TurboTax or just hand it over to your tax professional. Now, there are dozens of crypto tax tools out there, and I've tried a couple of them, but the main one that I use seems to be the easiest and most affordable, and I show you exactly what that tool is, how to use it from start to finish to file your own crypto taxes in this next video. Check it out. I'll see you over there. God bless.